Hi, I'm Kathy. Welcome to Decoding Credit Card Scores, a beginner's guide to financial fitness. I'll break down 5 key components that make up your credit score: payment history, credit utilization, length of credit history, types of credit in use, and new credit, and they all impact your overall score, so I'm going to offer you tips on how to improve your current score. And then stick around to the end to see if you can answer 3 questions about your credit score. So let's make learning about credit the coolest thing you do this week. Credit history is the record of how you have dealt with your money and debt, including credit card accounts and other types of loans. Your credit history starts with your first application for a loan or a credit card. As you use them and pay your monthly balances, the lender reports details about your account activity to 3 credit bureaus: Equifax, TransUnion, and Experian. For example, they'll report the date you opened a credit card or a loan, your current balance, and your payment history, including any payments that you may have missed. When they receive that information, good or bad, they add it to your credit report. In turn, those reports are used for companies to calculate your credit score. Lenders utilize the reports and scores to evaluate your credit worthiness. Your credit utilization ratio is generally expressed as a percentage, and it represents the amount of revolving credit that you're using divided by the total credit that's available to you. A revolving account offers the borrower a steady source of credit that can be used for purchases and can be paid back many times. Credit cards and home equity lines of credit, or HELOCs, are 2 common types of revolving credit. Your credit utilization ratio is one piece of information that lenders use to evaluate how well you're managing your existing debts. Lenders typically prefer that you use no more than 30% of your total revolving credit that's available to you. So if you have $10,000 available to you on all credit cards together, they would suggest that having no more than $3,000 in unpaid credit be used. Otherwise, carrying more debt can suggest that you'll have trouble repaying what you borrow, and that could negatively impact your credit score. The length of credit history means any account you have that's been opened, because the longer an account's been open and active, the better it is for your credit score. This might be a more important account not to have late payments on. And they do this by calculating the average of how long all your accounts have been open. Then they find the average age of accounts to find your credit age. Types of credit would include revolving credit, open-ended credit, and installment credit. Each of these may impact your credit scores differently, but a variety of those credits that you manage responsibly can have a positive impact when your credit score is calculated. Here's how each type of these might specifically impact your credit score. Revolving credit, like credit cards, can affect your credit score by impacting your credit utilization ratio. And a low credit utilization ratio can show lenders that you have been responsible in managing your existing accounts, and you aren't overextending yourself. Making on-time payments on revolving credit also positively affects the credit scores. By adding revolving credit account to your financial portfolio, you can improve your credit mix. Open-ended credits, like HELOCs or those home equity loans, don't have a predetermined spending limit that's typically associated with them, and it won't affect your credit utilization ratio. But on-time payments made towards these accounts can have a positive impact on your credit score. Making timely payments on installment loans, one that you're going to pay down over time, like now when you buy an iPhone, can boost credit scores over time. This is because your payment history is one of the main factors taken into account when credit scores are calculated. Adding an installment loan can also help improve your credit mix. But unlike revolving credit, installment credit does not typically have an impact on your credit utilization ratio. And this is because the loan is set at a predetermined amount, and once it's paid, those funds can't be tapped back into again. New credit is a category that's triggered any time that you apply for credit that you didn't have before. This could include credit cards, of course, but also auto loans and mortgages. And a good credit score is important because it affects loan approvals, interest rates on loans and credit cards, as well as potentially benefiting areas like if you're trying to rent an apartment or even securing certain jobs, because it's likely that your credit score is checked before both of those things occur. According to Experian, a credit score of 620 is often the minimum credit score that you need to qualify for an apartment, and this falls into the only fair credit range. If your credit score is 700 or above, it's more likely that the rental application process will be easier for you since you have a good score, and that can help you stand out to potential landlords. Having a good credit score when you apply for an apartment can also protect you from needing to find a co-signer or paying a larger security deposit, because some landlords might require that when a potential tenant has less than great credit. You can get the best rates on car and homeowners insurance as well with higher credit scores. Most U.S. states allow credit-based insurance scoring, where insurance companies assess the risk that you might be as a customer based on how well you handle your money. A variety of other factors go into evaluating your rates, and insurance companies don't solely rely on your credit score in this underwriting process. Luckily, they can't penalize you for having a bad score by raising your premiums or denying you coverage or even canceling your policy. But according to the insurance company Nationwide, credit-based scoring results in the most fair assessment of an individual driver's risk. And the company reports that it actually lowers premiums for about half of all of its customers because of it. Having a high credit score can also make it cheaper to borrow money. If you ever want to get an auto loan, remodel your house, or even open a business, having a good credit score will qualify you for lower interest on nearly every kind of personal loan that you might need. For example, if you're applying for a mortgage, you could save upwards of 1% in interest. And this can mean a savings of at least $200 per month over the lifetime of a 30-year mortgage on a $300,000 house. Good credit means that you can access perks and enjoy the best rewards, because with a good credit score, you can take full advantage of the best introductory offers and reward incentives that are offered on new credit cards. As you continue to grow your credit score, this will allow you to be considered a higher tier credit card holder and be able to receive special invitations to exclusive events, free access to online streaming services, and other types of perks. Credit card scores are calculated with algorithms that are used by credit bureaus. They emphasize which factors carry more weight. For example, your payment history is 35% of your score, the amount you owe is 30%, the length of your credit history is 15%, new credit is 10%, and that mix of credit is 10%. Some common credit score myths is the belief that if you check your own score, it hurts you, or that closing a credit card can improve your score. In fact, regularly checking your credit reports and credit scores is an important way to ensure that your personal and account information is correct. And it might even help you detect signs of potential identity theft. As a general rule, it's best to keep unused credit cards open so that you benefit from that longer average credit history and the larger amount of available credit in case you need it. Credit scoring models reward you for having long-standing credit accounts and for using only a small portion of that credit limit. You should also focus on building good credit by establishing and maintaining a positive credit history. This can include responsible credit card usage, making timely payments, diversifying types of credit by opening many different types of loans. Credit scores break down into different ranges: poor, fair, good, and excellent. 800 to 850 is excellent. Those of you in this range are considered to be a low-risk borrower. 740 to 799 is very good. Those of you in this range have demonstrated a history of positive credit behavior and may have an easier time being approved for other additional kinds of credit. 670 to 739 is good, and this means that lenders generally view you as acceptable or a lower risk borrower. 580 to 669, though, is fair, and those currently in this category are often considered subprime borrowers, and that means that lenders consider you a higher risk borrower, and you might have trouble qualifying for any new credit. 300 to 579 is considered poor, and those of you in this range are going to have difficulty being approved for new credit. It's likely that you'll need to take steps to improve your credit scores before you can secure any new credit. You should be monitoring your credit reports, and this means regularly checking credit report accuracy. If you head to freecreditreport.com, you can check your scores and reports for free. They do have pay options, so read really carefully, but you can download your credit report and review it for any errors to see where you could better raise your credit score. They're going to describe which areas you're doing great in and which ones that you're going to need improvement. I recommend looking at one report every 4 months. And this might look like pulling your TransUnion report in January, Equifax in May, and Experian in September. I suggest this because each agency will let you pull your report once a year for free. And if you spread it out over the year, you can check all of them over the course of the year, every year. In my next video, I'm going to go over strategies to improve your credit. And it's going to include pay your credit card balance strategically, ask for higher credit limits and why, becoming an authorized user, paying your bills on time, disputing credit report errors, dealing with collections about your accounts, using a secured credit card, getting credit for rent and utility payments, and adding to your credit mix to increase your score. Because a good score is going to allow you to achieve your broader financial goals. Because responsible credit management contributes to your achieving your financial milestones, such as buying a home or even starting a business. Now, can you answer these 3 questions? Can I check my score for free all year long? Is having different types of loans beneficial? And does it matter how long I've had an account open? Understanding and decoding your credit score is a pivotal step toward achieving financial fitness because you're laying the groundwork for a healthier financial future. This has been Kathy. Thanks for joining me while you embrace the power of financial literacy and make informed decisions to enhance your creditworthiness and your overall financial well-being. If you're a subscriber, thank you. If you're new here, please subscribe and click the alert button so that you can change your relationship with money.